So let's get into the main topic everybody keeps bringing up, this whole idea around the reverse carry trade, the domino effect, and how it could potentially create the perfect conditions for an explosive XRP price event. Not because of hype, but because of how global liquidity actually works when pressure hits the system. But before we dive into that, quick note, whenever the market gets volatile, you need an exchange that doesn't freeze or lag. BTCC is definitely the one that I use when I'm trading fast moves because it handles volatility way better than most platforms. So yeah, the link is in the description if you want to check it out. Now, the reverse carry trade story didn't appear out of nowhere. People in macro circles have been talking about it for years, long before it made headlines. And recently, it actually started showing signs of unwinding. When Japan began raising interest rates more aggressively, it actually shocked the market because Japan has been the global cheap money source for nearly 2 decades. Huge institutions borrowed yen at extremely low rates, converted it to dollars, and then invested that money into higher yield assets all over the world, including US treasuries, equities, FX, you name it. And when Japan hikes rates, the entire carry system starts to shake, as you probably can guess. Suddenly, the debt becomes more expensive, the yen strengthens, and the trade that worked for 20 years becomes unprofitable almost overnight. And that's when you get violent reactions in global markets, like the sudden 13% drop in the S&P in a single session. So those moves don't happen unless major liquidity is being pulled out fast. And when liquidity drains, it drains from everywhere, including bonds, equities, and crypto, anything that was funded through that cheap yen engine. And that's the first domino. Now, if you connect that to the broader digital asset world, when you have a liquidity crunch, traditional settlement systems become a huge liability. Stock markets still settle on T+1, which means trades take a full day to finalize. And in calm markets, that's okay. But in stress markets, that delay definitely becomes dangerous because institutions need settlement to happen instantly, not tomorrow. And here's where XRP comes into the conversation. R3's primary settlement token in that ecosystem is XRP. If you combine that with the fact that XRP is one of the few major assets in the US that actually has legal clarity because of the Ripple versus SEC case, and suddenly it becomes one of the only digital assets that institutions can legally and operationally plug into a settlement model during a crisis. And meanwhile, the new XRP ETFs are rolling out one after another, pulling supply off the market quietly through OTC desks and dark pools. You already saw a tiny preview of this when Kraken showed a brief 9-to-1 XRP wick during an S1 filing moment. It wasn't a real sustained price, obviously, but it revealed just how thin liquidity really is above the current range. This doesn't mean XRP has to go to 3 or 4 digits. Nothing is guaranteed, but it's the first time all these elements, global macro pressure, settlement upgrades, ETF demand, supply thinning, and legal clarity, have all existed at the same time. And when you stack them together, you can see why some people think a scenario like this could send XRP much higher, much faster than most expect. Whatever your stance is, the important part is understanding the mechanics, because once liquidity starts to move, it doesn't ask for permission, as you all know. It just finds the fastest path. Okay, thank you so much for listening, and I will see you in the next one.